All right. So in the same way, kind of Murphy Business Sales, I'm an investment banker. And when we go into a deal, we're really acting as quarterback, right? And that means that there are roles all the way through a deal that have to be supported that we can't do, we don't want to do, and you need an expert in that place. So whether that's, accounting, whether that's legal, and then we have a person on the panel that's really has done it all and is the business perspective and now is acquiring companies to give the kind of psychology of the buyer. So, and then obviously tax and planning is huge. You have to get through accounting diligence, legal diligence, and then what are you going to do with the money? So with that, I'd like to start with you, Bodie, and talk a little bit about, what is the most common issues you see in the financials, especially if they're looking to try to get through a quality of earnings or readying for a sale?
Yeah, I've been thinking about this, and still remember one of the first private equity deals I came in as a consultant on the now CFO side years ago. It was post-integration. Two sides were trying to come together. We're in there to fix the accounting and the financial reporting to get visibility into it. But I was new to the firm, and I remember there was a $2 million working capital adjustment coming from a misunderstanding of when that company owned their inventory. Was it when it was put in the shipping container, when it was put on the boat, or when it was landed here in the U.S.? The accounting wasn't necessarily done wrong. There wasn't any fraud on that. It was just one misunderstanding, not driving clarity early on in that working capital calculation that, potentially had the seller on the hook for $1.5 million, $2 million just from that one little misunderstanding.
Yeah, absolutely. And there are situations where if you don't do it now, right, you're going to have to do it eventually to get cleaned up, to get through a quality of earnings. So I'm going to jump around kind of expertise a little bit here. So Fareed, if we're talking on the legal side, really kind of understanding when you're trying to put together so you can prepare for legal diligence. What are your thoughts around kind of best places to start, or how you would actually build here's what the legal liabilities are and prepare for a transaction?
Yeah, if we're focused on the sell side, well, hey everyone, Fareed Kasani, glad to be here. A lot of energy and a lot of excitement in this room. So thanks for having me up here. If we're talking on the sell side, the place to start, would be to kind of really having an assessment, whether you do it through a sell side quality of earnings, or you're just doing a kind of an internal assessment of how would you want this to be viewed if you were buying a business? Are your contracts documented? Are all of your relationships understood? Even if your contracts are not documented, how can you describe the relationships you have to a potential buyer? Having those types of assessments in place, having your financials have some clarity, because that's obviously one of the biggest parts of diligence is for a buyer is they want to see how this comes together. How are they going to get the business they're expecting to buy, and how else do you do that other than the financials? Of course, the operations then have to match up with it. So that's probably where I would start, and then probably going to more micro details there on backwards planning from those points.
Yeah, absolutely. And you mentioned the business they're trying to buy, right? So understanding the risk profile, and that kind of goes to Walter, if you want to talk a little bit about from the psychology of a buyer, because that's where you play. What are you looking for as kind of risk level and understanding that?
Well, it's an investment, right? So you're putting money in and you want money out. It's not like you're buying a company just because you love companies. You're buying something because you're trying to make money on it, and typically it's a return on your cash flows. So you look at your cash flows, you look at the EBITDA of the business, and you look at revenue growth, and all of those things. Usually, when you get a business or you see a business, you usually ask them, give me your financials, show me your pro forma, where you're going as a business. You have to believe those numbers, first of all, and if there's high growth in their pro forma, and it's not believable, it makes things super hard. So I think it goes back to trusting the people you're talking to. I think acquiring a business, I think, I wouldn't say a lot, I would say 80% of it is the interactions and the relationships you create between the buyer and the seller. It's not as simple as you might think. You're walking in and you're buying something. You're trying to put your trust into is this a real business? Is this a brand? Is this something that's going to last? That I'm going to put money into and it's going to give a return for a reasonable amount of time, whatever you look at. For us, as an example, as a company, we are not going to sell it. We're going to buy a company to keep it. We're not going to buy it to sell it. We're going to get cash flow out of that business over time. And so it's a good long-term investment for us. So we are very, very concerned about the people that are there in the business, who's running the business, are they reputable, do they know what they're doing? It does go back to all the numbers and the financials and doing all the diligence and making sure that as the deal's getting done, that you're not getting bamboozled, because that's always an issue. But typically for us, as we walk in, as we get a sim, we start looking at the numbers. A lot of times we can very quickly understand if a business is not real or if it really isn't what they say it is. So usually we bypass those. We get tons of those. We go through those. Go through those quick ones, and we'll pick out the ones that we like. And we're like, okay, this looks like an interesting business, and they do the same kind of thing that we do, or they do something that we understand. So this seems like something we could invest in. And then we start going a little deeper, and we want to make sure they've got good bankers and good people representing them on their side. And then we meet with them. And once we've met with them, we usually can tell if it's going to be something we like. And if it's not, we walk away, which is most of the time. But every once in a while, we find one, and we love it.
Yeah, and you mentioned some of that. So you see a sim and say you like it, and it turns out something was inaccurate. That is game over. Whether the founder knew that or not, right? If they didn't do, say, on the sell side, getting their accounting cleaned up, get through a quality of earnings, and they aren't being able to actually tell you what their legal liabilities are and what the dollar amount is, that's kind of a pass.
That's an immediate walk away. We walk away. We're not even interested in talking to them at that point.
Or a major discount. You're not going to get what you're expecting. As a buyer's going to want to discount all those things, and you may not like the number. And if you don't like the number, you don't like the situation, you probably have some work to do. It means you're probably not ready for a sale.
That kind of leads into, so digging down on the accounting side, the construction industry. I don't know how many people are here, but that's a really complicated revenue recognition, right? Talk about doing deals, how significantly the EBITDA can change if they haven't been doing it right, and then the buyer does a quality of earnings.
Yeah, no, I mean, that's where we've always, with our clients, always talked to, being audit ready, have your financials clean. You might not entertain selling your company now or in the next 5 years, but act like you are and always get that put together. We've also been doing a lot of sell-side quality of earnings. It's been a process, too, for those that are interested in, want to entertain the idea, or like, yeah, in the next 5 years, I want to exit. Going through that process with them to really understand, how attractive is their business. A lot of these owners come in and they're like, yeah, I want to 10x on my EBITDA. I'm in this space, and coming to find out, they're pushing through a lot of their living expenses. There's a lot of adjustments that we need to make to actually get it to reflect to a apples to apples comparison of another company. And construction in particular, there's a lot of that revenue recognition where it gets in the weeds, it gets technical, and a lot of companies, when they get to that point to be attractive to sell, the accounting's just grown with them. They've never really taken the time to say, all right, we're going to go through an audit. I'm going to spend that time and energy to get through an audit. So there could be significant changes in that revenue recognition, which flows down to the EBITDA. But going through that quality of earnings process with them, there's another voice in the room to get them to really understand what does their company look like, what do they need to work on, and the sooner you can start doing that and going through that process, being ready to sell and be in the best position, not have to take a haircut when a LOI comes out, when there's a couple things that they might not thought it was a big deal of, I pay myself $100,000 a year salary, but I don't take it out. It's accrued, but it really should be, $300,000-$400,000 to get somebody of equal talent in there to run the business once that person steps out.
Yeah, those issues around, sell side quality of earnings and getting the accounting ready is kind of the first step. I mention construction just because it's the most egregious usually, because it's so hard to follow GAAP in that, and we've seen massive changes, right? So, Adam, on kind of your side, people usually are thinking of you as after a deal's done, oh, we'll go talk to them. Talk to me a little bit about professionalizing years early, or at least before a transaction.
Exactly. It's never too early to start thinking about the exit. I mean, as soon as you form the company, it's really like you could start thinking about it. But you know, the sooner you can get started on these things, you know, getting your accounting in good shape and starting to develop a plan of, you know, Geraldine talked earlier today about structure. Are you in the right structure? These are all questions and issues that need to be addressed years in advance before you plan to exit, not, you know, a month before or afterwards. I just had a client just a couple months ago come to me, and you know, he just sold his business and was asking if I could help him with some tax planning. And it's like, well, you closed on this 4 months ago, so hands are a little bit tied right now. There's not much we can do. If you would have came to me, you know, a year in advance, we'd have some wiggle room. But
I mean, qualified
start
small
early.
business stock 5 years early if you want to gift it.
Exactly.
Right?
Yeah, that's exactly what I was going to say out to that. I tell my clients to think about this before you even acquire the business. Like, what is your exit going to look like? Because, right, some of these tax planning strategies, qualified small business stock, for instance, right, you know, there's hold periods. There's a lot of things you want to consider, and you want to run some analysis to see if that makes sense. And you can't do it at the end. You can't do it when you're at the 1 yard line. You got to do it at kickoff.
Yeah, including what was mentioned earlier. Do you decide to be an LLC because you're going to turn and burn and sell it as an asset sale, or do you become a C corp and try to go for qualified small business, right? So we'll go through kind of the diligence items and go through everybody. So if we start with you, Fareed, what are the documents and things that people need to have all together in the data room that they may not be thinking of?
So part of that depends on what the buyer's looking for in your industry, but typically you're going to want to have your financials, your P&L statements, your balance sheets, your tax returns, cash flow statements. You're going to want to have all your documentation and general information related to your employees. Anything if you have benefit plans, if you've got leases or other real estate involved, you want to have documentation for that. If you've got depending on the type of business, if you've got potential warranties, things like that. For instance, you mentioned construction. If you've done a lot of construction projects and they've got tailed end warranties, a buyer's going to want to know that potentially to make sure that those liabilities don't fall on them. Typically, and there's a pretty long list of diligence questions that's like a base that we start with in an M&A transaction.
Like way longer than you would guess.
Yeah, and I can't even scratch the surface on it right now. There's just too many, and then. But the bigger the deal, the more complicated it is, right? If you're selling if you're an airplane manufacturer, it's going to have a very specific and long list of diligence items that a buyer is going to be looking for. But kind of on high level stuff like things like that, like your financial stuff related to your employees, your material contracts, who are your vendors, who are your suppliers, who are your customers, what are those terms going to look like? Yeah. Let's see, what am I missing?
I'm going to throw a big one out there for you. The cap table. Make sure that your investment, whoever's invested in your company, that has to be all nailed down. Because if it's not, you start going through diligence and try to close the deal, and then we get to the last minute, and everybody's got to sign a bunch of crazy documents that they don't want to sign. That's bad news.
Yep. Yeah, I mean, the first time we did a traffic control deal, we had to chase around the titles to every piece of equipment. They were leased, so they didn't even have the title. The bank held it. So now it took 30 days to get a copy. We never did that again. We always told somebody up front, let's take a month to go get all of our titles, right? Yep. And Walter, you kind of touched on it a little bit already, but as far as things that need to be in the data room the second you get in there, so you're not having to chase pieces down. I mean, in your industry, maybe specifically, what are you making sure is in the data room before you really invest in a process?
I'd keep it simple. I would say pick good advisors. You have to have, typically, at least the companies we've worked with, usually they have, not always, but they have good attorneys. They have good accountants that have, like a real accountant, not just a friend or somebody else, but they actually have somebody that's done a decent Q of A if it's been done. They've done their homework ahead of time. Hopefully they have an investment banker or somebody that represents them. On our side, we want really good attorneys on the other side. You have a crappy attorney that thinks that you're going to get in a cat fight every time you have a conversation or discussion, because there's so many things that are happening through the deal. Because you're constantly, as you're going through diligence, you're finding things and you're having conversations. And as a buyer, we're not trying to screw the seller. That's not at all the intent. The issue is there's liability here. There's risk. You just added risk to the deal. There's something that could happen down the road. You didn't disclose that. Maybe you didn't know about it, but you didn't disclose it. This is a risk. This is something that's going to be an issue for us. We have to put money in escrow. We have to do something here to solve this problem. And so we go through all those things during that deal. And if you have a bad attorney, you're gonna have somebody that doesn't understand how these deals work, and they don't understand what's market in a deal like that. And you're going to end up having, our attorneys have to do all the work at that point.
Yeah, I was going to say sometimes you get these smaller deals where it's like, who's your accountant? It's like, oh, well, my wife just handles, all the financials. It's like, okay, well, we're gonna have to roll our sleeves up here a little bit.
It may have been a bit of a transparent question to prove you should not do it yourself. There's a crazy amount of things you need to do, and you need good advisors. So, kind of moving to you, Bodhi, on this. Going through that process, what are the things that most people would not guess are kind of involved in the financial portion of due diligence?
Yeah, I'd say, maybe not quite the answer you're looking for, but one thing that we've, going through a lot of these transactions, speaking to, have people on your team that's been through this and can understand maybe some of the skeletons or crossroads you're going to be coming to in a transaction and help avoid those. But when talking to diligence, one thing that, I don't know, I would say surprising, but a lot of people don't put a lot of stock and effort into is these long requests, answering, hundreds of pages of questions and pulling these documents. Being on the sell side, putting your company out there, how fast can you turn those requests? How fast can you send in those titles? How fast can you answer those questions? Do you have all of your leases on file? If you can turn those pretty quickly, that's a sign to the person that's interested in buying you that, hey, this company's well operated, they have good intentions, and that can help you on the sell side navigate some of those conversations that might be a little bit trickier versus, oh, I need my lease contract. I didn't know. I'm going to have to go find that or dig it up, or it's a paper copy. So just that piece of it of, how fast you can turn and answer questions does help out, and it's one of those things that people don't really think about till you're on the other side of the transaction.
Yeah, I would add those due diligence requests lists are often much larger than you anticipate, especially, at least, the business owner, it's kind of a surprise to them sometimes. So
Yeah, when I say in the sale process, one of the reasons we need to represent you is because there's literally hundreds of diligence items. People are like, oh yeah, like I'm making it up, and they're like, wow, there's like 1,000 diligence items.
Well, and that's where things get crazy. That's where it's right in the middle of that stuff where things get super hard with acquisitions. That's because the seller, a lot of times the business owner or seller, it's like, hey, this is my baby, and why are you saying it's ugly, and why are you asking all these questions? And it's no big deal. This is not a big deal. Like, stop asking these questions. Stop worrying about this. And why do you keep drilling down on this thing? And why do you need more documents on this? And they keep asking all these questions. Well, as a buyer, I don't know this person that well. I seriously don't know that business that well. I need to understand better what's happened here. And then as soon as you start discovering, because you do discover things, it's all trust, right? So you're trying to build a relationship, you're trying to keep things going with each other. You want to make sure the deal gets done the right way. But also, as a buyer, this is my money. As our company's, like in our case at USANA, this is our company, it's our money, it's our cash that we're putting in, and we're a public company. We're not going to take a big risk. We have to be SOX compliant when we're done with all this thing. We may have to make sure that everything we disclose is straight up, and so we have to be very, very careful in the way we do this. It's more difficult than you think it is.
I was going to add that I think this is where the advisors again become very important. In my ideal world, the buyer and the seller are maintaining a good relationship in this process, both pre-sale and post-sale, because it really needs to be a smooth transition for this to go as planned and for the price to be justified. And so in the ideal world, it's the advisors that are kind of going back and forth to making sure all these are done, so we keep the buyer and the seller on generally happy terms.
Friends.
We did a acquisition and we finished in December, and I think the total valuation was $260 million, and we did the opposite. I told the bankers, don't talk to these guys. Let me do it. And so I spent every day on the phone with the founders of this company saying, hey, we're going to get through this.
Yeah.
It's going to be okay. We're going to get through this. We're going to get some ugly things. We all hate the attorneys, but we all just, the way we went through this is let this be what it is. This is just a process. Don't take it personally. This is just the way things work. And and just stay cool, stay calm. And I think we did that. We did a good job doing that.
And I was meaning like the advisors talking to the advisors, right? If it's outside of that, it can get ugly.
Yeah, because what happens is, and that is where it's the attorneys, having good attorneys talking to each other, that's a big deal. Having bankers talking to each other, because sometimes bankers, we've had some bad bankers too, that like they want to show how cool they are or something, and they screw up the deal. But typically, I think controlling your advisors, making sure that the advisors are keeping things cool, and making sure that things don't get into a fight, because you don't have to. You're negotiating up front. You got to try to negotiate everything up front, which is your term sheet. You put your term sheet together that has all your basic rules, everything you kind of like. This is what the deal should look like. After that, you just need to move forward with that. And if there are small adjustments, you make those, but you don't do massive things after that.
All right, let's jump in a little bit more technical. So talking about specifically cash-free, debt-free, and talking about disclosures. Why don't we start with you? Kind of what people should expect.
So cash-free, debt-free is a pretty typical structure in lower middle market M&A transactions, where as the name suggests, the buyer is not buying any cash or a very small set amount, and there's all debt, all liens, all encumbrances need to be released from the business. So that's the concept. Pretty easy to understand. The buyer brings their own cash. They bring in working capital with them, and they expect to buy a business without any liens on it and no debt. Sometimes it's a little bit easier said than done, because if you close on Thursday and payroll's due on Friday, well, you need to have plans for how you're going to cover the payroll. You need to have plans for how you're going to, if you're buying accounts receivable, how you're going to make adjustments for what's collectible and what's not. There's a number of factors that go into it, again, which is why you want to be working with advisors to kind of making sure you plan for that. And it's not necessarily the lawyers that'll structure it, but it's working with your financial advisors that can kind of lay out the blueprint, and then your lawyers will hopefully be documenting that properly.
Yeah. The amount of business owners that you talk to, kind of first time selling, my enterprise value is $100 million, so I'm getting $100 million. If you could talk a little bit about kind of all of those buckets and the cash-free, debt-free, and why that isn't the case.
There's the enterprise value on there too, but there's the working capital, I guess I would come back to, is that as well as, there's going to be a certain amount of capital that it takes to run the business, and who's going to be leaving that in, or who's going to be bringing that money to the table. And also, speaking to if they're buying the accounts receivable, if they kind of clean house or other people come in and the attention isn't on accounts receivable anymore, there's a delay there, and accounts payable has a balloon in it, and there's all of a sudden an emergent need for cash, who's going to be putting that money in? So more going back to the enterprise value of the business owner operator, getting them to understand all the other intricacies that could still come up post-close once they get their buyout, their portion of it, or how much equity is going to roll. There's still a business that has to run at the end of the day, and now there's two people that are invested in it, but who's going to be putting in the checkbook?
Yeah, if the saying is a deal dies 3 or 5 or 7 times before it closes, right? One of those around networking capital, right? If you want to talk a little bit, Walter, around when you're trying to buy a company and they really don't understand holdbacks, working capital. I mean, that's yeah.
No, I mean that's always the problem. That doesn't kill the deal, but it makes everybody really mad at the end, and it's always at the end when that stuff, because that's literally because you've done all the stuff, you've done all the diligence and everything, but then at your very end, and all the accountants get involved, and then they're all looking at they're looking at all the numbers, and you're like, okay, guys, you owe us, you know, X amount is going to come out of the check, or it's going to be, and then we have to pump a certain amount of cash into the business because it's a clean slate, so we got to put cash into it, and at that point, that happens every time, and that's always been an issue, but. I mean, it depends on how good your advisor. If your advisor's good and they're just telling you up front, then you're not going to be freaking out at the end, but it's the way it is.
Go to that transparency piece of it too. You know, it's going to be there. It's going to happen. It's something you got to address. And I was looking at statistics around it because, in my experience, that's really where expectations aren't met. It's the deal's closed, and all of a sudden it's like, oh man, there's this big old thing we got to address. Because a lot of times it is at the end, people are deal fatigued. They want to get the deal done, and now it's when everybody comes in and starts talking about this working capital calculation. But some of the statistics around it was 90% of private equity deals right now have a working capital adjustment after the deal's done, which is up from like 50% a decade ago. And 55% of those, or 65% of those favor the buyer. So it's the seller that's on the hook to bring in more money, or they have to take money out of the account and escrow as well. Yep. I mean, this is a known thing out there in these deals, but escrow, like a lot of people are like, hey, I don't want to park that money. What's going to happen to it? Is it going to come back to me? Escrows are usually around 1% of the deal value, but some of these other liabilities that are out there, you know, that could take up that entire escrow. So the working capital is a big thing, and that's where a lot of missed expectations come to the surface.
Yeah, I mean, I've seen up to 10+% on escrows as well. So I think it depends on, you know, what the size of the deal.
Yeah, and the buyer, by the way, from the buyer's perspective, buyers don't want to get in a lawsuit either. Buyers don't want to go back and try to scrape money back, and even if it's sitting in escrow, there's still an issue there. And so buyers typically want a clean deal, and they just want to deal with it and just move on. But yeah, when liabilities, things come up that weren't disclosed or whatever happens with escrow, then that money's going to get pulled.
Yeah, I mean, litigation is incredibly expensive if you've never been a part of it. And it gets expensive very fast. And I think over half of M&A deals end up in some form of litigation. And so having these types of issues nailed, and it's around these types of issues, yep. You know, having these issues nailed down up front is critical.
Yeah, I mean, you see clawbacks and things like that. And we talk about in that working capital bucket, we try to come to our best estimate, 90 days out. And we usually push making it a peg, right, where one side can get the difference or the other, and it's in the escrow. And at least that avoids having to claim fraud or something and claw money back if you have a peg. But this is not a comfortable thing. I think from a seller's perspective, the entire last 3 months of the deal is just they're losing more things. They feel like they keep getting told they're going to get something, and then just keeps getting worse and worse and worse until they, you know, either snap and back out of the deal or they don't. Let's talk a little bit, Walter, just kind of expectations up front, and then I'll talk a little bit about it, and then how you would set that to a crowd of people if you were talking.
I don't know how to fix anybody's. I can't fix that for anybody, but it's all the way through. It's like at the very beginning, everybody's super excited because like, holy crap, we're going to make this much money. It's like, I'm going to be rich, which they are going to be rich, but there's a certain expectation. And then it's like things happen and it's like, oh, really? Okay, well, you guys have that. And what happens at the end, it goes back to the liabilities for the business. I mean, that's why, you know, you're either buying the asset or you're buying shares. But when you're going through when you're going through all of that, you're going through all those details, and you're like, oh, we just discovered something. You said that this was like in your pro forma, and you were going to make money off this, but this is risky, and it's something that really isn't going to, maybe it's not going to happen, or you have these people that sent you this letter, you know, 6 months ago, and they were pissed at you, or you had a Prop 65 thing, or you had whatever, you had something, and they're like, well, that wasn't a big deal, but we sent a nice letter back, and everything was fine, nobody said anything about it. It's like, no, actually, that's an issue. And so as you get through this, you start carving out these little things, and you go, well, this is a problem. Like, this really is a problem, and This is a $300,000 problem. This is a $1 million problem. This is a $5 million problem. And they're like, well, that's not a really problem. Well, that's not an issue for us. Go ahead and put the money in escrow. And if it's not an issue, it's not an issue. It's no big deal. And then, of course, there's an issue that then there's trust, right? Because at that point, you're the seller, and you kind of know the buyer, and you kind of like them. Maybe they're good people, but you're going, okay, you're holding my money, and you're controlling my money for X amount of time, and you could literally grab it from me, steal it from me. And so there's all these conversations of specific how you're going to get that money, like under what conditions you're going to get that money, and all that stuff gets spelled out back and forth with the documents and with the attorneys. And that's where it gets hard in diligence. I mean, getting all the information is easy. Going through that purchase agreement and getting that thing all the way down to the finish line, it gets very, very difficult.
My favorite was, they told you in diligence they wanted to see your top 10 customers, but it turns out customer 11 is a family member, and you forgive their AR every single year. And it's like $1 million, and you're at a 9 multiple. So sorry, you're getting $9 million less. And even I, as the sell-side investment banker, like, I can't really defend that one. Really wish I would have found out beforehand, because I look dumb too. So, yeah, there's a lot of places that can happen. Yeah, wholly hypothetical. Yeah, or running your polo team through the business, and we have like $20 million of EBITDA add backs.
We had a company in the 90s. This is my first deal. My first company. We had a company called Viewpoint. We were doing 3D graphics. We did everything in the 90s. Anything, all the movies or anything. We did all the 3D models for that. It was a cool company. Anyway, we sold the company, and we sold it to Computer Associates. And as we're going through the sales process, we get a letter from Porsche, and they go, "Hey, you're selling these 3D models of Porsches in your 3D catalog, and that's our intellectual property, so you can't do that." And we could have easily just said, okay, that's fine, don't worry about it, we'll just, we'll take them out, whatever. But instead, we knew we had to disclose this, so we disclosed it. We went back to CA and we said, guys, hey, we got this letter, it's not an issue. And they said, yeah, it is, it's an issue. So they held 10% back in escrow. We never got sued. We all got our money, we all got paid eventually. But the money sat there, I think, for 4 years, and it was reasonable. It was a risk for them, and they were concerned about it.
Adam, if we're talking about, I'm gonna ask a very general question, and you can go with this how you like. But if you're looking at somebody in the crowd that's maybe 3-5 years out from selling, or maybe selling in the next year, what is the best piece of information you could leave them with on thinking about your planning, your exit, your tax position?
I would say start early and get a good team of advisors around you. I mean, and we've talked about that a little bit already, but when you're building your team, you want to have people that are, have expertise in the particular area that you're dealing with. So, is that a tax attorney to help you with structure and complex, tax issues? You want a good CPA. Do you need a M&A attorney like Freed, that's very knowledgeable about deal structure and all those type of due diligence issues, and investment bankers? You want to get that good team around you. So that'd be probably my main piece of advice.
Awesome. On the accounting side, kind of the headline for this talk, what you should take away with you and think about.
Yeah, I would say, going back to plan your exit the day one you start the company, or day one you acquire a company. It might not be an idea you ever think I'm going to buy and hold this thing forever, but you never know what opportunity is going to come knocking. And the better prepared you are for it, it's only going to do you best served to have that ready for a possible deal to come through. There's a lot of intricacies in accounting in particular that you don't need to worry about until stuff like this comes. So the more prepared you are, the more you can talk about it, the more sophisticated that you come off to a potential buyer is going to go a long way to your ending valuation.
We had kind of a joke in our company when we'd have like a new MBA come in, and we'd say, guess what percentage of our buyers' financials are ready to go into a sale deal? Maybe like 25, I don't know, 50, 75. 0% so far. Everybody says at the start, oh, our books are super clean. This is going to be easy. We have everything in order. And like 2 weeks in, it's like you have no idea what you're supposed to be at. So, and then Fareed, talk a little bit about kind of your perspective on what you'd leave with them, but also kind of readiness that most people have.
Yeah. I think it's not even having your exit, from the time you acquire. I think it goes before that, especially on things like your tax planning. That's huge up front. I think looking at, what's my industry, what's my EBITDA target, what's my multiple be, like, well, what am I going to get there? Is it going to be 3 years, 5 years, 7 years? Having all those considerations in mind. I like to tell every client, have your exit in mind from day one. Like, what are you getting? How are you going to get out? What's it going to look like? And so I think from there, you could kind of backwards plan the entire process. So that's that. And then, really understanding, if you're acquiring a business, remember, someone's going to be going through the same process you are, especially if you're doing it right. If you just kind of go in there blindly, well, maybe you'll get lucky and you'll find a buyer like that. But expect that you're going to have a sophisticated, if you want to command the multiple that, to really maximize your exit value, then you're going to probably be working with a sophisticated buyer that's going to have a lot of questions. And so it's fair for them to ask those questions if they're going to pay for that high multiple. So you need to be prepared to give them what they're looking for. And that means organization, planning, a clear story.
And actually, the fact that they're going to understand the business is a really good thing. I have multiple stories now where an independent sponsor, which is kind of like a PE guy who hasn't got his wings yet, right? He's starting on those individual deals before he's proven himself to get a fund, came in and bought a $100 million asphalt company. And about 2 weeks after close, he goes, you have to add money in and buy equipment to grow this business? And it was like, it's an asphalt company. The guy ended up going, basically the sponsoring fund behind him fell out, and he ended up selling back to the founders at like 30 cents on the dollar. So now we're back in, they had done it without us, and now we're in market with them to sell the exact same company, and they've made a killing on it. But you can't believe that they had like a year, 2 years of dealing with a guy who bought their company and had them running it, but didn't realize they needed to buy more equipment to grow an asphalt company. So if they're asking those detailed questions and they're really understanding the business, that's a good thing, right? You don't want a partner who doesn't get your business or how they're going to drive growth, especially if you're rolled equity. So, Walter, if you want to kind of give what's that title, that highlight that someone can take from today if they're thinking and they're in the place to sell soon.
Okay, well, maybe your baby is ugly. So I've done a ton of startups in my career. I've been through sales. I mean, I'm actually a lot older than I look. I'm probably in my 90s at this point, but I've done a lot of deals over the years, and some of them were startups that just didn't work that well. We thought we were doing great, and we thought people were super excited about it, and we would go talk to people about our business and say, "Man, this is going to be worth a lot of money to you," and they just weren't that excited about it, and we couldn't figure out why. And then we really weren't listening to them because what happens in a typical business is you're spending all your time selling, and then when you're dealing with investors that are going to go and buy your company, they don't look at it the same way as a customer. They just look at it completely differently. They're looking at it as, how am I going to get my money back? Like, how am I going to make money at this thing? Not is this tool going to be nice for my business? It's just a completely different way of looking at it. And so you really, I think the most important thing is to just be very honest about your business. I would definitely have advisors that can help give you feedback. I back in the good old days where, people did multiples on revenue. Good luck with that if you're ever going to think you're going to get that, because maybe you have something really, really special, but if it's like a lot of other businesses, it has to be a multiple on EBITDA, and it has to be real EBITDA. I don't know what your adjusted EBITDA looks like, but it has to be, your adjusted EBITDA has to be real adjustments, not just like, we have legal fees every single year, and we're going to throw those in our adjustments and make more money off this thing. It just doesn't work that way. I think it's just reality. At least my experience, buyers and investors, especially buyers, are going to really scrutinize your business and really look at things. And if you don't have your act together, then maybe it's not a good time yet and you need to get ready for it. I would also advise you that if you're going to sell a business, I'm not going to, if you're a potential seller to us, don't listen to what I'm about to say to you. But if you are a business that's going to sell, become very profitable, because it's based on EBITDA again. So if you can drive your profitability up, and you get some smart people in to help you do that, because maybe you're not that smart, maybe you are, but if you're not smart enough to do that, or if you don't have the experience, either operationally or to fix your COGS or your SG&A or whatever you're trying to fix, get on top of that stuff ahead of time, because you might be leaving a huge amount of money on the table because you're trying to get out early or trying to do something irrational. There's just a lot of opportunity there, and I think, like I said, I would really pick good advisors. Don't just listen to everybody that just says, oh, you're going to get X amount of dollars out of your business. Really listen to people that really know that, really understand it. And if they're telling you something you don't want to hear, they might be telling you the truth.
Yeah.
It's excellent.
Yeah.
Oh yeah, it's excellent. I was going to say we should open up the
Awesome.
floor here for just a few Q&A questions. Does anyone have any questions for them? Now's your time. It's the best time to ask a...
No questions about making a huge amount of money. You sure? Yeah.
I'll hold it close to my face. In the exit strategy planning, in my experience, I worked 10 years with private equity groups buying businesses. Now I work with Murphy helping people sell businesses. The things that you spoke were spot on. They need their financials in order. They need their balance sheet in order. They need to understand what the process is going to look like in due diligence. But if you're the one buying the business, please don't send us that 100-page Google due diligence that has nothing to do with the business. Focus your due diligence on what this business actually does, because there's nothing that turns off an owner or a seller more than questions that aren't relevant. They want to know that you understand their business and that you need to move forward with them. When I meet with sellers, their very most important thing at the beginning is the value of their business. Very quickly, what becomes most important is who's taking over their business. So make a connection with the owner. Be personable with the owner. Understand what they're going through. This is their baby. And statistically speaking, just like you said, businesses that sell, businesses that get exit strategy planning early are 50% more likely to sell, and they sell to 15 to 25% more money. So start the process early. Get your advisors, get your lawyers, get your intermediaries involved so that they can help you through the process. And I really appreciate all the things that were brought up. Thank you.
Thank you.
I'm going to add to that. I think for a lot of sellers out there, having the right buyers is very important, because for a lot of people, even though you're exiting, it's still a legacy. It's still your employees that you've built relationships with. It's still your name and your reputation in your community. So I think that's a really valuable point.
Yeah, we've kind of done the same. I mean, this deal that we just did, I think the reason that I know the reason that deal happened was because first I met them in New York and with their bankers, and it was kind of ugly because I'm really direct and it doesn't always work that way. But we asked them to come and visit us, come to our offices and visit us, and we weren't sure if they were going to accept. And so we just kind of said, well, if they accept, we'll see how it goes, and if they do, maybe we can build a relationship with these people. We like their company, but it either is going to happen or not. They came out, they met with us. We really liked them, and they liked us. And that's after that, we tried not to take advantage of them, which I don't believe we did at all. And we just tried to get a deal done at that point, and it worked out really well.
Any other questions? Right. Back here, Lance.
For things that you saw that went really, really well. And part of this question comes from me constantly talking to people that are doing what I want to do with my business in the future. And while I see them as advisors, sometimes I struggle to know what advisors I should be networking with.
So I'll take the first one. In an M&A deal, there's only really two things that you and your advisor are trying to do. You're trying to sell the future, and then you're trying to lower that perception of risk. So in using your advisors to be able to professionalize the company early on and then make the due diligence process professionalized, you're talking about a significant increase. And the number is pretty easy to understand. Let's say you're selling to a private equity fund instead of to Walter, right? And they have a 5-year hold period. If they're coming into the business and they're buying it knowing they're going to have a dead year where they have to put in software systems, planning, training, and they have to get the business professionalized, they now can give you exactly 20% less, right, in a 5-year hold period. So that's where it's really significant, is coming into preparing before you go to market. And then, like Walter alluded to, having all of the answers tight and quick and making the due diligence process fast increases the value. The last thing is, if you have 90 days that you're going through due diligence, say after you signed a letter of intent, if you are only spending 30, 45 days on actual diligence, and now you've got 15 to 30 days to sell your business because we've done so well making diligence easy, there might be some things that come out about the structure, the way you built the business, and you'll be able to sell all those interesting things and opportunities that are out into the future. So being professionalized gets you the higher offer, and then going through a professionalized due diligence process fast gives you the opportunity to be what you're the best at, selling your business. And the numbers can go up. Everyone thinks they only go down, but in many cases we've seen the actual closed cash go up because a company was run so well and diligence was so easy.